They are telling you to just work harder, save your pennies, and eventually you will be able to afford a home. They tell you that buying a house is the ultimate American dream and the only real way to build wealth. That is the biggest financial lie of 2006. If you are currently renting and feeling completely locked out of the housing market, do not panic. You are actually in a uniquely powerful position provided you know exactly what to do next. Welcome back to the channel. Today we are exposing the brutal truth about the 2026 housing market, why the middle class is being systematically priced out of home ownership, and the exact step-by-step strategy you can use to build massive wealth even if you never buy a house. Let us look at the cold, hard reality of the numbers right now. The median home price in the United States has skyrocketed to nearly $430,000. At the same time, mortgage rates are stubbornly sitting above 6.5%. For the average American family, the math simply does not work anymore. To comfortably afford a standard home today, you need an income that is drastically higher than what the vast majority of jobs are paying. But why is this happening? It is a perfect storm. We have a massive shortage of millions of homes because builders stopped building enough houses after the 2008 crash. Then, during the era of rock-bottom interest rates, millions of people locked in 3% mortgages. Those people are refusing to sell because they do not want to trade their cheap mortgage for a wildly expensive one today. This creates a severe lack of supply. And when supply is low, prices stay artificially high, even when the economy gets tough. On top of this, massive Wall Street corporations have been quietly buying up single-family starter homes, turning entire neighborhoods into permanent rental communities. To truly understand why the current housing market is a trap, we have to look closely at how a modern mortgage actually works. Most people look only at the monthly payment. They see a number they think they can squeeze out of their paycheck and they sign a 30-year contract. But they completely ignore the amortization schedule. When you take out a loan at over 6.5% interest, the way the bank structures your payments is predatory. During the first 10 to 15 years of your mortgage, almost 80% of your monthly payment goes directly into the bank's pocket as pure interest. You are barely touching the actual principal of the loan. This means that if you buy a $400,000 home today, by the time you fully pay it off in 30 years, you will have handed the bank over $800,000 in total. You are effectively buying two houses, keeping one for yourself, and giving the other one to the banking elites for free. The financial system wants you to believe that this is equity building, but in reality, it is a wealth transfer from your pocket to Wall Street. Furthermore, the hidden costs of homeownership are reaching catastrophic levels in 2026. The traditional narrative completely ignores the phantom expenses that come with a property deed. Let us talk about property taxes. As home prices are artificially inflated, local governments are reassessing property values and raising taxes to record highs. In states like Texas, New Jersey, and Illinois, homeowners are realizing that their tax bills are growing faster than their wages. Then we have the insurance crisis. Due to inflation and rising climate risks, major insurance companies are completely pulling out of massive markets like Florida and California. The homeowners who stay are seeing their insurance premiums double or triple overnight. If you are a renter, your landlord absorbs these shocks. If you are a homeowner, you have to pay up or face foreclosure. And let us not forget maintenance. A standard rule of thumb is that maintenance costs about 1 to 2% of the home's value every single year. On a $400,000 home, that is $4,000 to $8,000 a year just to keep the house from falling apart. A broken air conditioner, a leaking roof, or a cracked foundation can instantly wipe out your entire emergency fund and force you into high-interest credit card debt. When you rent, your rent payment is the maximum amount of money you will spend on housing each month. When you own, your mortgage payment is simply the bare minimum. So how do the wealthy navigate this exact situation? They do not look at real estate with emotion. They do not care about a white picket fence or neighborhood status. They look at the numbers. They understand the fundamental difference between an asset and a liability, as taught by the greatest financial minds in history. An asset is something that puts money into your pocket every single month, whether you work or not. A liability is something that takes money out of your pocket. Unless you're renting out rooms or treating your property as a commercial business, your primary residence is a massive liability. It consumes your cash flow, restricts your geographic mobility, and ties up all your liquid capital in a highly illiquid brick-and-mortar structure. If the market drops, you cannot easily sell your house to survive. You are trapped. If you are a renter right now, you have a massive strategic advantage, but only if you choose to play the game differently. You can completely outpace the net worth of the average homeowner by executing the opportunity cost strategy. Let's break down the exact math. Imagine a scenario where renting a nice apartment costs you $2,000 a month. To buy that exact same house in today's high interest rate market, your total housing cost, including the mortgage, taxes, insurance, and maintenance, would be $3,500 a month. That leaves a massive gap of $1,500 every single month. The average consumer takes that extra $1,500 and spends it on lifestyle inflation. They buy a newer car, they go on expensive vacations, or they buy designer clothes. This is why renters stay poor. But an investor takes that $1,500 and deploys it immediately into the global markets. Let us look at what happens over a 15-year period if you take that $1,500 and invest it into a low-cost stock market index fund that tracks the top 500 companies in America. Historically, the stock market has returned an average of about 10% per year over the long term. Through the power of compound interest, investing $1,500 every single month at a 10% return will grow into over $600,000 in 15 years. In 20 years, that number skyrockets to over $1 million. And here's the beautiful part. That wealth is completely liquid. You can access it on your phone in seconds. You do not have to pay a 6% real estate agent commission to get your money out. You do not have to wait 6 months for a buyer. And you do not have to worry about a roof leaking. While your homeowner friend has all their money locked inside the walls of an overpriced house paying massive interest to the bank, you have built $1 million liquid empire just by renting and investing the difference. If you want to win this financial game in 2026, here's your advanced 4-step playbook. Step number 1 is to run the numbers completely naked of emotion. Stop listening to the social pressure from your friends or family who tell you that you need to buy a house to be an adult. Use online calculators to find the price-to-rent ratio in your specific city. If buying is significantly more expensive than renting, accept the reality and proudly remain a renter. View your rental agreement not as a sign of failure, but as a strategic lease on flexibility and capital preservation. Step number 2 is to automate your investments. Do not trust your willpower to save money at the end of the month. Set up an automatic transfer from your paycheck directly into your investment account the day you get paid. Allocate your capital into broad market index funds or exchange-traded funds that hold high-quality cash-flowing businesses. These companies are run by the smartest CEOs in the world who are constantly working to increase profits and return value to shareholders. By owning these funds, you become a part owner of the global economy. As inflation drives up the prices of goods and services, the profits of these companies rise and your investment portfolio expands naturally to beat inflation. Step number 3 is to utilize real estate investment trusts, commonly known as REITs. If you still want exposure to the real estate market but refuse to buy an overpriced single-family home, REITs are your ultimate weapon. A REIT is a company that owns, operates, or finances income-producing real estate. They buy massive apartment complexes, medical buildings, data centers, and warehouses. By law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. When you invest in a REIT, you get all the benefits of being a landlord, collecting monthly rental income and capitalizing on property appreciation without any of the headaches. You do not have to deal with broken toilets, bad tenants, or property managers. You simply sit back and watch the dividend cash flow hit your account every single quarter. Step number 4 is to change the way you look at real estate if you eventually choose to buy. If you absolutely want to own physical property, you must stop buying traditional single-family homes. Instead, you must learn the strategy of house hacking. House hacking means buying a small multi-family property, such as a duplex, triplex, or fourplex. You move into one of the units and you rent out the remaining units to tenants. In a correct house hacking setup, the rental income collected from your tenants will completely cover your mortgage payment, your property taxes, and your insurance. This allows you to live for free while your tenants actively pay off your bank loan and build your equity. This is the only way a primary residence becomes a true asset. It is how young, smart investors build multi-million-dollar portfolios before the age of 30. The global economy is shifting rapidly, and the old financial playbook is completely broken. The institutional elites, the central banks, and the mega corporations want you to take on massive 30-year debts because debt is the ultimate tool of compliance. When you have a massive mortgage payment due every single month, you cannot quit a job you hate. You cannot take risks to start a business. You cannot travel the world. You are locked into the system. But when you choose to remain liquid, when you keep your housing costs low by renting, and when you aggressively invest your capital into real producing assets, you break the chains of financial slavery. Wealth is not about owning a piece of land with a massive debt attached to it. True wealth is about freedom. It is about having the cash flow to make choices based on what you want to do, not what you are forced to do. It is about looking at economic volatility, not with terror, but with anticipation, knowing that you have the liquid capital ready to buy up assets when everyone else is panicking. The 2006 housing market is a textbook wealth filter. It will drain the resources of those who follow traditional, outdated advice, and it will reward those who understand macroeconomics, opportunity cost, and the power of compound interest. You now have the knowledge, you have the data, and you have the strategy. The path you choose from this moment forward is entirely in your hands. Before we conclude this masterclass, I want to ask you a very direct question, and I want you to give me your honest answer. If you are currently renting, are you going to continue to invest the difference, or are you still feeling the pressure to buy a home despite these high interest rates? Let me know your exact strategy and your thoughts in the comments section below. I read every single comment, and I want to build a community of educated investors right here. If this long-form documentary gave you massive value and opened your eyes to the real mechanics of wealth building, make sure to hit that like button, subscribe to the channel, and turn on all notifications. Share this video with a friend or family member who is currently stressing out about the housing market and needs to see the real math. Stay disciplined, protect your capital, and keep building your liquid empire. I will see you in the very next video.